Hi, this is Tom Essaye from Money and Markets TV. Right now, the markets are totally focused on how the world's major Western central banks will respond to the sovereign debt crisis in Europe. The headlines are all about whether the Federal Reserve, Bank of England, and European Central Bank will make their monetary policies more accommodative. And the expectation of more quantitative easing has helped stocks rally throughout June, even though no actual policy easing has occurred yet. But as a contrarian investor, I'm looking beyond the headlines to other regions of the world where monetary accommodation is already starting. Two of the BRIC countries, China and Brazil, are aggressively cutting interest rates and taking other pro-growth measures to help stimulate their economies. Australia also recently cut interest rates as its economy slowed along with China's. Since the financial crisis, we've learned that when a country's central bank begins easing monetary policy, its stock market tends to outperform over the next few months or even years. And I don't see any reason to think the same thing won't happen this time. In other words, you want to buy when central banks are doing more quantitative easing and sell when they aren't. If you had just followed this one strategy for the past few years, you could have reaped huge returns in the U.S. market alone. That's why I'm watching 3 ETFs focusing on countries where the central banks are ahead of the curve in trying to stimulate growth. The iShares FTSE Shenhua China 25 Index ETF, the iShares MSCI Brazil ETF, and the iShares MSCI Australia ETF. Just keep in mind, you may not see immediate results in these funds or the stock markets they track. That's because interest rate cuts and other monetary policy tools are very slow moving and often have a lag effect. Think of it like turning a cruise ship. It takes a while for the ship to react after you've turned the wheel, but once it starts turning, it's very hard to stop. This lag time presents a great opportunity for investors. Although the markets haven't reacted yet to the announcement of more monetary easing, we know that they soon will. That allows us to buy on the cheap. It's a perfect example of the contrarian strategy of looking beyond the market's immediate concerns to find the next big trade. Emerging markets are already actively stimulating their economies, so it's a good bet they'll be the next region of growth as more established central banks follow their lead. I'm Tom Essaye from Money and Markets TV, and thanks for watching.